To be a successful investor, sometimes it's just as important to know what to avoid as it is to know what to invest in. I'm Mitch Goldberg, and I'm going to share with you 3 things to avoid that have helped me save a lot of money for myself and for my clients. The first thing on my list of things to avoid is a stock at the year low. As if somehow a stock trading at a year low implies a floor underneath the stock or some invisible level of support. But in my experience, my opinion, a stock at a year low means often a stock that is going lower. Damaged goods, something I want to avoid. The second thing of things to avoid is a stock with a low PE ratio. Now keep this in mind. I'm talking about a stock with a lower PE ratio than its sector peers. If a sector or an industry of the stock market happens to have traditionally a low PE ratio, that's not what I'm talking about. What I mean is if a sector has a particular PE ratio of, let's say, 15, but an individual stock in that sector has a PE ratio of 8, much lower, that to me is not a bargain. That's not a discount. Some investors think it is. I think it's a mistake. I think it's a stock heading lower. I think it's, again, damaged goods. The third thing, okay, so far we went over a stock at a year low, a stock with a lower than sector or industry PE ratio. Third thing, a stock with a higher than industry or sector dividend yield. Now, I like a good dividend yield as much as anybody else, but if a particular stock has a much higher dividend, like an outlier higher dividend yield than its peers, to me, that implies something negative. It implies to me a company that looks like it's going to cut its dividend, which traditionally is not a very good thing for a company's stock, okay? Another way to look at that with dividends is the dividend payout ratio. So if a company has a very high dividend yield, and let's say it's a $20 stock with a $2 dividend, 10% yield to it, to 20 is 10%, but the company's earnings are only $1 or 50 cents, but a lot lower than the actual $2 dividend, to me that means it's a company whose dividend is not sustainable, and that company is going to have to cut the dividend yield eventually. Again, it's a situation that I like to avoid. So the 3 things that I like to avoid, again, that have saved myself and my clients a lot of mistakes, a lot of heartache, a lot of money, is a stock at the year low, a stock that has a much lower than industry or sector PE ratio, and a stock with a much higher than industry or sector dividend yield. Okay, thanks for watching. If you find this video helpful, please give it a thumbs up and please subscribe to my YouTube channel. Thank you.